Hey everybody, welcome to this free edition of our Trader User Weekly Roundup for the trading week ending February 2nd, 2024. I'm Preston Brett. Thanks for tuning in. And of course, the theme this week, no doubt, is big tech keeps on rolling. Let's take a look at how we did this week. Really amazing. If you look at the data, you can see that the only one that suffered this week was the small cap, the Russell, coming in at a negative 87 basis points. So it's down 3.26%. Everybody else is up. The week kind of started off a little bit weak. We had a busy earnings week, Q4 earnings, with Microsoft, Google, and AMD basically missing, and markets just down a little bit on those. And then we had strong surprise, upside surprise from Amazon and Facebook or Meta. And that really moved the markets higher, even though Apple sold off just a bit. But Meta and Amazon really kind of took the day, right? And that kind of pulled everybody else back up, Microsoft and Google and AMD, just a little bit. You can see the PE ratio is still very rich at 22. I think we're going to see some settling in price. Dividend yield 1.46, and the 10-year Treasury still over 4%. But look at the VIX. It's at 13.85. We've been slowly moving higher in the VIX. I'll show you the chart in a minute. And if we look at this week, in addition to the earnings, we did get Boom Powell. He basically said the base case is they're not going to cut rates in March. It's the first time I heard him actually come out and just pretty much say it. Markets sold off. I think that day we finished down 77 points, but we still managed to finish up by the end of the week. But the chances of a rate cut went from 3 or 4 weeks ago over 80% down to under 20% in their March meeting. Now, we did get a very strong labor report on Friday. It came in at 353,000 non-farm job payrolls, double the consensus, but almost all the jobs, if you start looking in the detail, were part-time. And the average work week fell to 34.1 hours, which is getting near or in recession territory. So we got to be very careful here that there's a big, long, over an annual lag effect in these rates going higher. So we're going to have to follow the earnings or the jobs data very closely, or just follow it very closely. The 10-year yield went up on Friday after the jobs numbers, but it still managed to finish lower for the week, right? So we've got that shaping up. You can see the best and worst performers of the week or just the opposite of last week. Discretionary, the winner. Energy, the worst. Year to date, communication services leading the way. Real estate is just really getting cut up, taken to the woodshed, just because rates are going to be staying higher for longer, right? And if we look over at the European markets and just kind of see what's going on there, Euro stocks and FTSE in the green, but barely. You can see it's kind of a mixed bag there. The CAC 40 and DAX both in the red, but just barely. And they're barely year to date in the green. The Euro stocks is only up just slightly under 3%, which isn't that bad year to date. It's 50 of the largest companies in Europe. But I'll remind you that the Eurozone just barely avoided a recession. Their GDP came in the final quarter at 10 basis points in the green, just barely. If it had finished in the red, it would have been in a recession. And the Bank of England also came out, kept their interest rates at a 16-year high of 5.25. But Europe is having some trouble, right? And then, of course, if we go over and look at the Asian markets, if we look at Nikkei in Japan, I mean, they're very solid, 1.14 for the week, but 8.05 for the year. They're leading everybody, okay? The Bank of Japan, they had their monetary policy meeting at the Bank of Japan, and there's growing confidence that they're going to achieve their price stability target. It's getting in sight now. So they're going to start to normalize monetary policy. At least that's what a lot of analysts think. Now, that remember, they wanted to do this in Q4 of last year. At least that was the analyst call, but they didn't do it. In the end, sold off. So I think there's going to be some opportunities there. Members, we'll talk about it Sunday for our weekly market watch. All right. And that they're the only one of the few that's still running negative interest rates, but they're looking at terminating those, and we're going to see the yen just really move higher when they start doing that. All right, it's going to run for a while. But look at the Asian market, China and Hang Seng. China, ugly week, 6.19 for the week, 8.23% year to date down. Ugly, ugly, ugly. They're continuing to put out downbeat economic data. Their PMI data is still in contraction territory at a little over 49. Okay. The other thing is they did a survey of the top 100 real estate developers there, and their year-over-year value of home property prices fell 34%. Huge drop. And on top of that, there's going to be a liquidation of Evergrande, the world's largest real estate developer, but not anymore. And a lot of analysts believe that's going to further weaken the Chinese financial system as well as confidence in their real estate market. I think it's going to take them a while to get through that issue, right? So it's not going to be very pretty as it goes. I want to take you over right now. Let's go over to the E-mini S&P 500 futures. Let me just get that screen up for you guys. Here we go, right here. We'll take a look at that first, and then I'll show you some other things. The breadth of the market is still much weaker than I would like to see it, right? I mean, just really weaker than I would like to see. You can see over here that we hit new highs on Friday intraday, right? I do believe we're going to pull back, probably come down at least. We're probably going to come back down and test 4,900 sometime in the month of February. I don't see a big pullback, but 2 to 4% makes sense to me in February going into March. And then I see another run higher and then a bigger pullback sometime in April, May timeframe. All right. That's kind of what I'm looking at here on these markets. Now, look at the FANG index. If we look at the FANG index, you can see it's up 13.52%. Look at these gaps. These gaps will be filled. You can see this gap right here from January 23rd to right over here on the 24th. It came back down and pretty much filled that gap intraday, and then we came right back up again. So I do see this being backfilled sometime in the month of February. Now, we had strong momentum on Friday, and generally when you have strong momentum on Friday, you kind of pull it out on Monday. Although we started to sell off on Friday around 3:15 p.m. Eastern Standard Time, and it just kept moving on down all the way through until the markets closed around 7 p.m. Friday night in the futures market, right, or in the aftermarket, and just kept slowly going down a little bit. So I do see it's going to be real interesting to see where the markets come in next week. We've got some earnings, but no mega cap tech. And the following week, we got CPI, so that'll be an interesting one, but that's not till, I think, week after this coming week. So this is the FANG, and then, of course, if we look at the mega cap 7, you can see here, not as high as the FANG, believe it or not, but you could see it's up over 11%, right? Right in this area right here, 11%. Again, a lot of gap fills. I do believe it's going to kind of backfill a little bit and fill that in. But that's kind of what I'm seeing here. And then, of course, if we look at NASDAQ, it's not doing as good as obviously the FANG or the MAG 7. Its last time high was January 24th. It was only up 4.64. Even though the mega cap and those guys are about 45 to 48% of the NASDAQ 100 as far as index value. Remember, there's another 40 or 50 stocks out there, and they're not doing nearly as good, right? If we look at the let's look at the equal weight SPX. You'll see it's just barely in the green for the year, right? So the only ones really moving right now, these, you could probably say there's a top 10 of which the Mega 7 are in them, right? And there's a few others out there too, but that's about it. We need extended breadth. Otherwise, this is going to eventually peter out, right? And we're going to have a little bit of a pullback. It may be similar to what we got in the first and second week in January, where we pull back 2 to 3.5%, maybe 4%, and then we settle in and we make another run, right? I could see something like that coming through, and how it moves. But look at the small cap, the Russell. We've been in the red since we opened this year, and then we just kept going down. See how the 50 EMA is holding? If it breaks and takes out the 2024 lows, it's not going to bode well, but I do believe that's kind of where we're in store for right now, okay? And then, of course, if we look at the VIX, you can see the VIX. I put a regression channel on it, so you can see which way this thing is going, left to right, up. Very steady as she goes. We're still in the green, but it's moving higher while the markets are moving higher. So anytime you have the VIX moving higher while the markets are moving higher, generally the VIX wins out, and that suggest a little bit of a downdraft in the equity market. So don't be surprised when we get that in the next 2 or 3 weeks. Not a big one, like I said, but we will see it. And then the bonds had a really ugly day on Friday. It fell over 2 full handles. You could see that move there. Intraday, it was in the green, but when it closed, it was in the red. Bonds have been in the red all year long. Remember, when bonds go down, interest rates go higher. And the markets are now trying to rapidly adjust to rates staying higher for longer. You can see the 10-year, it's moving up. I suspect it's going to continue to move up a little bit. Okay. My target for the interest rate 10-year was down here around 368, but I also said the Feds are the only ones that can really change that. The markets still are betting on 5 rate cuts for the year. Feds are still at them out saying 3. So understand there's a difference between being able to cut rates because you can and being able to cut rates because you have to. If they have to cut them, then the markets will be right and the economy's not doing well and they're cutting 5 times, 4 or 5. The Feds right now are just saying we're going to have a soft landing approach and we only need 3 rate cuts. So it's going to be real interesting to see who wins out that battle. Okay. If we come down here and look at currencies, it shouldn't be a surprise. The dollar's up, doing really well. In fact, we made new highs in the dollar on Friday, up 2.8%, because the economy's doing strong in the US and interest rates aren't going down. So you're getting good money on the rates and people want to hold dollars. Of course, if you look at the euro, it's going to be just the opposite, right? Euro's below the 50 EMA. It closed below the 200 EMA and hit the lows for the year, which were made on February 1st, down a little bit over 2.44%. This is forecast to have a little bit of a rally and then roll back over again, which would suggest rates are going to stay higher for longer, right? So just understand that. And that's kind of been my view with interest rates, the dollar. And I do believe the economy is underneath the surface, it's weaker than it looks. Okay. And then, of course, if we look at gold, you can see gold is doing the camelback tour, up, down, up, down, up, down. Members, we'll go through the best way to trade this, but I think you guys know on this right now with gold, there's really nothing to talk about with gold, right? And copper goes where China goes. And you could see here copper is just rolling back over. You could see this was just an ugly start to the year right here with copper. It made a rally, an attempted rally, but it's just rolling back over again, all right? And as long as China does not do very well, copper is not going to do very well either. Oil, it's almost back in the red for the year, okay? Look at this. Here we go. Intraday, we almost went below into the red intraday. You can see the low price for oil was early in the year. But this is kind of where we're sitting right now. Now, oil is a good prognosticator for a recession. If we have a recession, oil is going to come back down to my target. Now, I've got a target down here in the low 60s, right? So it's going to be real interesting to see if we hit this. And the reason why is global demand. If you look at global PMIs, manufacturing, we've been below 50 for a while now. It's just not that pretty. Manufacturing everywhere is hurting. China, South Korea, Japan, here in the US, Europe, not doing that good. So is this a precursor to a bigger pushback or a pullback in the markets in early summer? I believe we're going to see something like that. Nothing, we may get a little bit of a scare of the children moment. I don't think we're going to move in a bear, but I do believe we're going to get a 5 to maybe 10% official correction territory sometime in the early summer months, okay? And then, of course, if we look at nat gas, it's starting to get interesting to me again. We're back down at a very low level. If I back it out right over here, let me just back it out for you guys so you could see. Right here, we're right at the level here where we started trading it all last year to the upside, doing bull put spreads. So members, we'll take a look at some strategies on this here shortly. But I do believe this could go lower. Remember, weakened manufacturing and hints of a recession can drive this even lower, right? So we got to follow that very closely. All right, everybody, that's a real quick update on this. If you're not a member, I highly encourage you to come in. We've got a lot of folks coming in over the past 6 weeks. Members, I will see you this Sunday evening at 7 p.m. this time instead of 8, 7 p.m. for our Sunday weekly market watch. Otherwise, make it a great weekend, everybody. Ciao.